Namaste to all. I welcome you all to this another panel discussion on another aspect of the accounting standards. Today, what we are discussing is the accounting of leases. Another very important point. Namaste to all. I would say I aspect of the accounting. And for that, we have got very eminent panelists out here. C. Archana Bhutaniji. Many of us know her because she has been a regular faculty speaker having more than 20 years of experience. And she has been a regular contributor to the ICI. She has been on the board of ASB under various other committees, EAC, AASB, and a regular faculty for the ICI. I really thank and I welcome Archana Bhutani to be always there whenever ICI needs her. So she's always there sharing her wisdom with everyone. And she also was a special editor with the 18th edition of the Ramaiya and got more than 20 years of experience. Though she doesn't look like having 20 years of experience, but yes, she has got it. That's great. I also welcome our another speaker, another panelist today, C.A. Kaleshwar Prasadji from Bengaluru, Karnataka. Archana ji is from NCR. Prasadji, again, apart from being a chartered accountant, he has done his bachelor's degree of law, CISA, and also recently the International Financial Reporting diploma he has done. And again, he's into the teaching line, faculty, and into the subject of accounting and auditing itself. I welcome you, Kaleshwar Prasadji, for agreeing to share your wisdom out here.
Thank you.
And he's also having more than 18 years of experience. And to moderate these two star worlds, we have got a young and dynamic Astha Gupta-ji, having more than 5 years of experience, chartered accountant at Delhi, and have a good knack for accounting and taxation aspects. Friends, if I talk about lease, yes, some might call it a rent, some might call it by some other name, license fee or something like that. But what is the lease? What is an operating lease, finance lease? What is there in the Ind AS? What is there in the AS? What is the applicability for non-corporates? You know, all those gambit, and we're not, of course, talking about the taxation aspect, but yes, understanding the whole concept of lease and how and when to account for under which of the standards. Is there any difference between the AS, Ind AS, and the IFRS? Talking all about that. We've got the whole panelists out there, and Astha to moderate. So over to Astha to take it forward from here.
Thank you, Pramodji. Before I begin, I would like to convey my heartfelt gratitude to the Accounting Standard Board, ASB of ICAI, for giving me this esteemed opportunity to moderate today's panel comprising of knowledgeable minds in the field of accounting standards. Today's webinar will address issues in lease accounting. For any organization to diversify or expand its operations, one needs huge investment, which cannot be satisfied merely through internal resources. And this is where leasing comes in as an alternative financing model. Having said this, with different attributes of leasing and different kind of lease products available in the market, it becomes very important for the finance function of the organization to be aware of proper accounting and financial reporting of lease in the financial statements. Today's webinar will be in a question-answer format, wherein I will be posing pre-drafted questions to our learned panelists. The idea is to cover the basics, few technical aspects, and some practical case scenarios while we go through the seminar. Everyone is welcome to contribute the questions during the session as well. We will definitely try to address them, keeping the paucity of time in mind. So without any further ado, let's begin today's webinar. My first question is for Kaleshwar Prasad sir. Let's start with the basics. What is the definition of lease and different kind of leases as per Accounting Standard 19?
Namaste. First of all, thanks to Accounting Standard Board for giving us this opportunity. Lease accounting, lease standard per se, even from our study days, we always find this topic to be slightly difficult. So I'll keep the discussion in a simple format so that it is easy for all of us to grasp it. Lease, as we say, it's a contract between two parties. It's a contract between two parties. The parties, we call them the lessor and the lessee. wherein one party, the lessor, the supplier of, he will supply the asset to the lessee, who is a customer for a period of time in exchange for a consideration. So basically what happens in this contract is a lessee, the consumer, even without owning an asset, get the right to use an asset for a consideration which is predetermined. So lease is basically a contract between two parties, wherein one party delegates or passes on the asset to the other person for right to use of an asset. Continuing this, so few important things what we have to note is, in lease, there is no transfer of ownership which happens at the inception. So there could be a transfer of ownership at a later stage, but it doesn't happen at an inception. So the lessor continues to be the owner of the asset. However, lessee gets a right to use an asset because of the contractual term. Accounting Standard 19 includes even this hire purchase. Standard itself says that we even include hire purchase transactions here. But one significant thing is it does not include lease of a land. So AS 19 says that lease of a land is not being covered as per Accounting Standard 19. So continuing this transaction, so what happens is, this could be further split into operating lease and a financial lease. Basically, the significant risk and reward in relation to an asset, based on that whether it has been transferred or not, will determine whether it's an operating lease or a financial lease. The risk and reward what we are talking is basically the risk in relation to technological obsolescence of an asset, economic fall down in the value of an asset, or so this kind of risk, if at all it is getting transferred by the lessor to the lessee as from the inception, then we call it as a financial lease. If it is not getting transferred, we call that as an operating lease. We can discuss this in detail little later. Over to you, Asta.
Thank you for explaining us the definition of lease as per AS 19. Now going on to Archana ma'am, I have a question for you. What is the definition of lease and what are the different kind of leases as per IND AS 116?
Okay, so let me put it like this. I wouldn't say that there are different types of leases under 116, when unlike, AS 19 or IND AS 17. And if it's okay, Asta, can I at this time maybe just take the participants through the leases concept, the lease model?
Sure.
So I think Prasad has already set the context in terms of what a lease is. And let me just give you the reason why the whole standard, why did we move from AS 19 or IND AS 17 to IND AS 116? So if, just like Prasad explained, lease, you've got operating and finance lease. In a very layman term, operating lease is more like a rental. You are not interested in having the ownership of the asset. You just want to use it for some time. Whereas in a finance lease, you intend to get into the position of an owner, okay? And the arrangement is more like taking a loan. So if you today, let's say, just book a car for 2 days, that's just like a rental. But if I take a car on lease wherein I will pay for the entire value, I take a loan and then purchase, it's as good as that. So the economics of the two are very different. Now, what was the challenge with the standard? And I'm just going to share some slides which are there by IASB. These are on IFRS 16, but since the standard IND AS 116 and IFRS 16 is converged, I think these slides very well explain the concept. The challenge was that typically companies would, the operating lease liabilities were outside the, just give me 1 second. The operating lease liabilities were outside the balance sheet, in the sense they were off balance sheet. So if you look at an operating lease, you never recognized an asset or a liability for those. You recognize the rental and you made certain disclosures in terms of the maturity as to how much is payable on these operating leases, in the next 3 years or the next 5 years or the next 7 years. So the whole concern was that when you were looking, let's say if I'm an investor, I'm looking at investing in a company, the company is committed to making certain payments, but that commitment is not on the balance sheet. So I think that was a whole issue. And the story, the revision of the standard, the whole story started with Sir David Tweedy, and many of you would have heard this, with David Tweedy, who was earlier the IASB chair, saying, when would we really see an airline, aircraft on the balance sheet of an airline company? Okay. So the issue was that you've got companies which are using these assets, but the assets are not on the balance sheet. And actually, if you ask me, more than the asset, the worry was the liability being off balance sheet. So a company is committed to making the payment, but there is no recognition of that liability on the balance sheet. So, and again, when Prasad will talk about AS 19 in detail as we go further, you will realize, and by your own experience, you will realize there was effort to structure transactions, the lease transactions, in a way that they'll end up being operating lease. Why? Just because they would be off balance sheet. Finance lease would be on the balance sheet, whereas operating lease would be out. So looking at the structuring possibilities, that were available because of the way the standard was worded in terms of the options you could put in, the variable payments, etc. And the bigger concern, like I said, not just the asset, but the liability being off the balance sheet was what led to a reconsideration. So what does the new standard intend to do? What does the new standard really do? So effectively, the new standard, which is Ind AS 116, brings the asset and the related liability now on the balance sheet. And to do so, this distinction that Prasad spoke about of operating or finance lease actually goes away. There's no such distinction anymore. There is, as far as lessee is concerned, there is a single accounting model. For lessors, of course, you'll continue to have the operating lease and finance lease classification. The standard makes very limited changes there. But for a lessee, the model is pretty different, single accounting model. And if I was to put it in a nutshell, effectively, you will end up doing what a finance lease accounting was. So after I can maybe, if you want, I can take it up in more detail now, or would you like me to do that later?
I think we can continue with this.
Okay. So as you would see, the lease commitments were not appearing on the balance sheet, and that is what led to the revision. And when you look at the new model, effectively what it will do is you will recognize the right to use. So you may not own the asset which you've taken on lease, but you have a right to use that asset for the lease term. And under the model of the accounting model of Ind AS 116, that right to use will be recognized as an asset. So you'll have that asset coming in. But of course, if I'm saying I have a right to use, let's say a building or a car or a ship or a warehouse or an airline, whatever it is, when I will recognize the asset, I also have to recognize the liability, which I have to pay for the use of that asset. So the liability is also recognized. So as you can see from the slide, earlier it was off balance sheet. Now under Ind AS 116, you'll recognize asset. You will also recognize liability. So when you look at the balance sheet will seem asset rich, but it will also result in, liabilities being recognized. So of course, it does affect your debt equity ratios and all those things. When you look at the impact on the P&L, okay, and I'll explain this a bit more in detail through an example. So under AS 19 or Ind AS 17, if a lease was an operating lease, let's say I have said I'm taking an asset on an operating lease for 10 years, and every year I will pay 1 lakh. So all that you would do is every year your P&L will show 1 lakh, 1 lakh, 1 lakh. So it's a uniform charge in your P&L, presuming no escalation, etc. Taking a very simple example, you'll recognize a same charge over these 10 years, and it sits in your operating expense, right? But now under the new model, what happens is, you would not have this rental coming in because you're recognizing an asset and a liability. The asset will be depreciated or amortized. So you will recognize the depreciation on that right of use asset. The liability, of course, you will unwind it for the time value, etc. And that would also result in the interest being recognized. So as you can see from the diagram, which is on the left-hand side, the single expense of depreciation, which was there under operating lease, will go away, and instead you will have depreciation and interest coming in. Just see that the accounting under Ind AS 116 or IFRS 16 is the same as is there under finance lease column under IAS 17. So that is why I was saying effectively this single model, accounting model under Ind AS 116 or IFRS 16 is effectively replicating finance lease model in a very broad way for all leases for the lessee without making any classification. What would be the impact of this change? Like I said, your single expense will get replaced by depreciation and interest. Now, depreciation, let's say, for example, the depreciation of the asset you're doing SLM. Okay, so it will be a constant constant when I say it will be the same expense across the lease term. But finance cost, the finance cost, when you unwind a liability, the finance cost is usually higher in the initial years and then it reduces. So as you can see from the graph on the right-hand side, your total expense in the initial years would be more and then it will reduce. So of course, the total expense, depreciation and interest over the lease term would be the same as you would recognize under the previous standard, but the pattern or the distribution over the years would change. So you would have higher, which is front loading in the earlier.
Yeah. Archana ji, there's some technical issue at your end. Can you hear us?
Ratio perspective, the EBITDA looks higher. And of course, the operating profit also, but profit before tax would be the same because, like I said, it's just kind of, it's just over the period, the expense would be the same. And similarly, when you look at cash flows, because your operating cost will go down, your operating cash flow seems to look higher, and the financing cash flows is increasing. So that's how it affects your overall presentation. It does have, like I said, higher asset value, similarly increase in liability on the balance sheet. When you look at P&L, there is front loading. Your single rent expense will get replaced by depreciation and interest with front loading in the initial years. If I can just quickly take you through this example, just think about a situation, let's say where you have a 5-year lease of an asset and you're paying, 1 million every year. Let's say no purchase option, nothing, simple 5-year lease with 1 million every year and a discount rate of 7%. And the useful life of the asset is 20 years. Now, what will happen is when you're paying 1 million every year, which means 5 million is the total payment you will make over the lease term, you will discount it, you will recognize an asset of 4.1 million and you will have a corresponding lease liability. So at inception, when you recognize the lease for the first time, your ROU and the lease liability is the same. Now, what you will do is you will start depreciating this ROU over 5 years. So every year, this ROU of 4.1, you will amortize it or depreciate it over 5 years and you get a charge of 8,20,000 every year in your P&L. You will unwind the liability of this 4.1 million. And let's say in year 1, you recognize an expense of 2,87,000. So this is how it will be. Your if you just think about it, what is now the total P&L expense? It is 820 plus 287, which is 1107 lakhs. Under the AS 19 accounting or Ind AS 17, what would you have done? You would have just recognized 1 million, right? So as you can see in year 1, instead of 1 million, which you would have recognized under the earlier standard, you will be recognizing 1.107 thousand. And of course, going in the later years, this will reduce so that the total expense is the same. So effectively, this is the red line shows, the uniform of this 1 million that you would have recognized across the period. But, when you look at the total depreciation plus interest, it is higher in the initial period and then reduces in the lower. So this is how the way the expense will be recognized in the P&L would change when you move from Ind AS 17 or AS 19 to Ind AS 116. So Asta, that's what I had on the model. Maybe we can move on to the next one.
Thank you, Archana ji, for such an elaborate explanation. And it's commendable that you've used the slides for better understanding. So good to, like, the tone has been set for, especially with the comparison between the Ind AS, IFRS and AS 19. So next we'll move on to Kaleshwar sir. Sir, please enlighten us on the accounting treatment in the books of accounts of lessor under different kind of leases as per AS 19.
Okay, so what happens? Lessor, the supplier of asset. So basically, how we will have a different accounting treatment if it were to be an operating lease and a financial lease. What happens in case of an operating lease is a simple thing wherein you will be recognizing year on year the lease rental income what you will be receiving it. That could be on an equal proportion, or it could be in a proportion to commensurate to match the usage of an asset. So continuing the same example, if I'm getting a lease rental of 1 lakh, either I could recognize over a period of 5 years, I could recognize 1 lakh equally over a period of 5 years. Or if it is in relation to usage of a machinery, how the machinery gets used in proportion to that, I can allocate the lease rentals over a period of 5 years. So operating lease is always simple. So as it has rightly been told, it's an off balance sheet. So balance sheet will never get impacted. I get a rental income, a lease rental income year on year, which I'll operate as profit and loss account. I continue to be the owner of the asset. I charge depreciation. When I charge depreciation, yes, subject to other things like impairment and other standards also comes into picture, and I continue to be the owner of the asset as far as operating lease is concerned. When it comes to a financial lease, what basically happening is the risk and reward, significant risk and reward in relation to the asset is getting transferred, even though ownership might be transferring at a later stage. This is a classical example of substance over legal form. Even in legal form, I may be the owner, but in substance, the significant risk and reward has already been transferred from myself to the lessee. So what happens is I have to de-recognize. So I no more an owner of the assets, I'll have to de-recognize. And then in case of this I'm explaining in terms of financial lease. Yes, I'm going to first de-recognize the asset by recognizing the gain or loss in relation to sale of an asset. Then what happens is I will be recognizing the lease rentals over a period of time. So continue the same thing in financial lease. Since I don't own the asset in substance, I will not be eligible for a depreciation. I'll be getting a lease rental income over a period of time. So this is what we do in case of a financial lease. This is what we do in case of financial lease. If time permits, we can even discuss the accounting treatment as far as 116 is concerned. I leave that choice to you, Ashta.
Okay. So going on further, can you also tell us from the lessee perspective, the accounting treatment under AS 19?
Okay. So the converse of what we did in case of a lessor will hold good in case of a lessee. When it comes to an operating lease, it's basically off balance sheet. I will be paying lease rentals for the usage of an asset over a period of time. So the lease rentals will be treated as an expense. It will be debited to P&L account as either it could be a regular installment or it could be in proportion to usage of an asset. Any other systematic basis if we are able to justify. So operating lease is always an easier one. However, when it comes to a financial lease, so what happens is in substance, I'm getting the ownership of an asset. So I need to recognize that. So we recognize the ROU of an asset with the corresponding lease liability. But important thing, what happens is I am not paying this money at once. I'll be paying this money over a period of time. So what we do, we ascertain the present value of future lease payments. And then the present value of future lease payments would be recognized as a lease liability and the ROU of an asset. So what we're trying to do is we are trying to eliminate the interest element or the time value of money from this transaction. On the ROU of an asset, based on the useful life of the asset, I will charge depreciation. When it comes to lease liability, what I have recognized the lease liability is basically excluding the interest element. The total future payments which I'm going to make it to the lessor is getting accumulated. That has got discounted and I have recognized it at a present value. Now, year on year, what we do is we accrete the interest. We basically load the interest. That interest expenses will hit the P&L account, and the lease repayment, the installment what I'm going to repay, will be apportioned between the interest and the principal, just like a bank EMI what we pay. So where portion of it goes to interest, portion of it goes to principal. So in the balance sheet, what will happen? My ROU of an asset will get depreciated and shown at a WDV value. The lease liability first get inflated with the interest for the period, and then get reduced with the lease payment what I have made, and the carrying value will be disclosed in the balance sheet.
Okay. Thank you for explaining the lease accounting under AS 19 from both lessor and lessee perspective. Archana ma'am, coming back to Ind AS 116, how do we identify if a particular arrangement of transaction is covered under definition of lease? And a few examples will be very helpful in this particular question.
Okay. So I think, lease definition, identifying whether or not there is a lease is going to be very critical. And let me just explain why. I mentioned in the earlier bit when I spoke, I said whether an item under AS 19 or Ind AS 7, whether the liability was off balance sheet or on balance sheet depended on whether you classified as an operating lease or finance lease. If it was operating lease, it was off, otherwise it was. Now, under Ind AS 116, I said all liabilities will all be on the balance sheet. So I'll tell you where the nuance comes in. Now, the test for off balance sheet, on balance sheet would be the lease definition. If I say a transaction is a lease transaction, I will have to recognize an ROU and a lease liability. It cannot be off balance sheet. But if the transaction does not meet the test of a lease definition, then it will be off balance sheet. Are you getting my point? So just like earlier, there used to be this thing about companies saying, is this operating or finance? Because they could decide off balance sheet or on balance sheet. Now the test would become the lease definition. Now the gating question would be, is it a lease? If it is a lease, then there is a liability. Otherwise, there's no liability. And this would require a very careful analysis of all your service contracts, because each contract, is it a service contract or is it a lease contract? Okay. If it's a service contract, then it will be, you'll account for it as per Ind AS 115. And Ind AS 115 does not require you to recognize a liability for services. So if I'm committed, let's say, to take services from you, I'm going to take maintenance services from you for the next 5 years. I'm committed, but I don't recognize a liability, right? But let's say if I was to say this is a lease, and not the maintenance service, but I'm just saying a transaction which can be either here or there, then I would have to recognize a lease. So now the lease definition would become the test of on balance sheet and off balance sheet. And quite often you have to appreciate, which was there even in the earlier standard, an agreement which meets the definition of a lease may not necessarily use the word lease. I can have an arrangement which is a lease without using the word lease. So I do not know how many of you would recollect when the issue of convergence with IFRS was being discussed. There was this huge concern even under Ind AS 17 about an interpretation which was there globally, which is IFRIC 4, right? And what did IFRIC 4 try and do? IFRIC 4 actually tried, it was an interpretation of the standard. It tried to say there could be arrangements which are so-called not drafted as a lease. It doesn't use the word lease, but are in substance a lease, and they intended to capture those. Therefore, like I said, the definition of lease therefore becomes very critical in that context. If I say it is a lease, it is on balance sheet. Otherwise, it is off balance sheet. Now, let me just take a simple example, and then maybe there is a big test in terms of the lease definition, and I'll take that, with the help of additional examples as well. Now, let's say I just have an agreement which says that I will be, purchasing, some gas from a supplier. So let's say I enter into a contract with you. I tell you, Astha, I would want to purchase these gases, and can you supply them? So what you do is you set up a factory just near my premises. Right. All the output, all the gases that factory produces are purchased by me. You cannot sell that to anyone else. The entire production is marked for me for the entire useful life of the factory, let's say. and the pricing is also agreed, etc. And through the pricing, I also take over any any variability or any risk and rewards of that premises. Now, so-called, the arrangement is drafted as supply of gases, but actually this could be very much a lease arrangement.
Right.
Similarly, let's say I enter into a contract, and this is a very commonly debated issue. I engage you to, let's say, put up the solar panels. I want solar energy. I tell you, can you please come and put up those solar panels? I agree on the design with you. You come and place those solar panels. Obviously, they're on my premises, the entire benefit of the solar energy which is produced is received by me, etc. and so on. Now, is this a contract for purchase of solar energy, or is this a lease of solar panels? Okay. So the point I'm trying to make is that the contract may not necessarily be titled as a lease contract. It could be anything, but you'll actually have to see, is there a lease, within the arrangement? And in that context, the definition and the criteria becomes very critical. So again, let me just share some slides, because otherwise it'll be very difficult, because there are quite a few conditions to see whether or not there is a lease. Give me 1 second.
Sure.
So when we look at the definition of, when we're trying to, in the examples I discussed, to see whether or not there is a lease or is it a service contract, there are certain conditions which the standard or kind of talks about. So first of all, there has to be an identified asset, and we'll discuss this going forward, because without an identified asset, you can't have a lease. So I'm going back to the very basic example I picked up earlier. Let's say I go to a car company. I say, give me a car, and I say I want a Honda City for 1 week. I'm booking a Honda City. Now, if this agency can give me any Honda City on day 1, another Honda City on day 2, etc., there is actually no identified asset. What am I doing? I'm only taking something on. I'm only taking the service of a car or a travel kind of a thing, just like you book an Uber every day, etc. When you're booking an Uber or an Ola, doesn't mean you're taking an identified asset. So, but let me contradict this with a situation wherein I say, this is the car, this is the registration number, this is the chassis number, this is the only car which will be made available to me. So till the time there is no identified asset, the issue of that's the first step to see whether or not there is a lease. And we'll talk about this in more detail as to how do you look at whether or not there is an identified asset. The second thing for something to be a lease is that I should get benefits of it. Okay. And it doesn't mean I have to be an owner of that asset. So there is a big distinction. Like I said in the beginning, what am I recognizing? I'm recognizing a right to use. I'm not saying necessarily I'm the owner, but during the period of the arrangement, I am the only party which can use it. So let's say if I take on an asset, let's say a building or anything, a parking space, any other asset. So let's say if I get substantially all of the economic benefits of this asset during that period of the lease term, then that is the second criteria to be evaluated. If I'm not the only one, anybody can, it can be even I may only get a minor portion of it, then it doesn't meet this test. The third is that who has the right to direct the use? So just think about it. We said we are recognizing an asset which is called right of use asset. So if I'm saying I have a right of use, how do I test whether or not the right of use of asset is there? Again, go back to the simple car example. If I can decide when the car will be used, where the car will go, how will it be driven, when will it be driven, and all those things, that is what gives you the economic benefits from that asset. So effectively, whether or not there is a lease would require you to take into account, is there an identified asset? If yes, you will see, am I getting substantially all the economic benefits? If yes, then I will see, do I have the right to direct the use? If I don't have the right to direct the use, somebody else has that, the supplier has the right to direct the use, then there is no lease. So there are three conditions to be considered, to see whether or not you have control over the use of the asset. I'm not saying control over the asset per self, but just see there is on the left side, it says control over the use, not control over the asset, but the use of the identified asset. That's the test we are trying to meet. So maybe you can see if you have any questions still at this stage. Otherwise, we can even get into further detailing of
okay, so I think you've covered the dependence on use of specific assets very well. So that portion is pretty clear. Can you explain what is the meaning of right to use an asset in this particular scenario?
So, like I said, the right to use an asset, if you look at the third box, it talks about how to use. Well, basically, the standard says the right to use would depend upon who has the right to use, depends upon who takes the for and what decision. Okay, how, for what and how decisions effectively. Okay, let me just take it in the context of a proper example. Let me just compare it. So let's just see what is IFRS 16 or India 16 defining a lease as. Lease is a contract which contains or it contains a lease if the contract conveys a right to control the use of an identified asset for a period of time in exchange for consideration. So let me just give me 1 second. I thought I had, give me 1 second. Okay, sorry, I thought I had some examples. Let me just take some examples by my experience itself.
No problem.
Yeah. So let's say, let me take the example of parking space. Okay. Now let's say that I have a building and I have also taken 3 parking spaces. Okay. So the first thing I would do is to think about, is there an identified asset? So let's say there are 30 parking spaces. I can park anywhere. I can use 3, but anywhere. Okay. Then obviously the test of identified asset is not met. Okay.
Right.
But let's say that the 3 parking spaces are identified. No one else can park in those spaces other than me. Then I will have an identified. Then I will see whether I get substantial economic benefits. And the third would be for and what decision. So I will see who can park the car there, when can the parking be done, etc. If I decide how that parking space will be used, then I have the right of directing the use of that asset. Let me take another one, maybe a better one in that context. Let's say that I want to transport some goods. Okay, so I come and ask for, you have a ship and I'm going to use that ship to transport those goods. Now, let's say if the ship already has, if you tell me, Archana, this is where the ship will go, this is how much you can put in, I will decide what route to take, I will decide which date the ship will go, etc. Then all that I'm doing is I'm availing these services of transportation from you. Okay. But let's say that if I say, okay, as I'm taking the ship on, from you for use for, let's say, for the next 2 years, I will decide when the ship will go. I will decide whether it will go tomorrow, day after tomorrow, next month, what the travel schedule is. I will decide how much quantity I want to transport. I will decide the route. Where do I want to take it from? Do I want to have a stop at some place? I don't want to have a stop at some place. Who will operate the ship? If I take those decisions, so how and for what purpose, as you can see on the slide, this would mean when to use the asset, how to use the asset, where to use the asset, etc. So in the second example I took, if I'm deciding when the ship will go, where it will go, what it can carry, what it can't carry, which route, then I am actually directing the use of that asset.
Right.
And let me just add 1 or 2 more things here. Quite often, let's say if I've taken the ship, when I have the arrangement of 2 years, let's say you as a party tell me that, Archana, you can, okay, this is for 2 years, but you can't take the ship into deep waters. Okay. So does it mean I don't have the right to direct the use? May or may not. It depends upon what is the condition you are putting in place. If that condition is protective, okay, then I would say it doesn't. Or similarly, let's say if you say on ship, you can't carry something which is, what do you call, can catch fire easily.
Yeah.
So again, that is protective. Or let's say that while I'm directing the how and for what purpose, I ask you for even giving me the crew who will manage the ship. But just because I've hired your crew to even manage the ship doesn't mean I'm not. If I am the one who's going to be telling them when, how, what, etc., then I have the right to direct the use of the asset. So quite often, the test, when you look at this how and for what purpose decision, you will actually have to see whether the rights are protective or rights are not protective, right?
Okay.
And there is a separate category of predetermined. I mean, if you want, I can separately explain what happens in case, how and for what purpose decisions are predetermined.
Okay, yeah, I think a quick review on that would be helpful for the.
So in the example, the ship example I took, the customer could take certain decisions. But what if the asset is such that all the decisions are predetermined? There is actually no decision to be taken. So let me take the case of the solar panel I spoke about, right? So you came, you installed the solar panels, right? Now, is there really any decision to be taken after the solar panel is installed? It will generate energy only when the sun is there. How much? There is already a defined capacity, right?
Right.
Once you've put in the panel, the capacity can't change. So effectively, if you look at it, once the solar panel has been installed, there is no decision making really. Okay. So in the case of a solar panel, how do I decide whether or not, who has the right to control the use or to direct the use? So if you've got an asset where the use is predetermined, all the decisions are predetermined, then you actually check, was the customer involved in the design? Because if I was involved in the design, then in a way I have already taken the how and for what purpose decision, right? But if I was not involved in the design, this is where right to operate will become important. So typically I don't bother about right to operate. But in case the assets decisions, the use decisions are predetermined, then I will also look at who's operating the asset. So in the ship example I took earlier, I said it doesn't matter whether the crew, and let me even say the captain is of the supplier. Okay. But let's say if the decisions are predetermined, then I will actually see who's operating the asset. So in a solar panel, let's say typically what happens, Asta, is that let's say I engage you to design the solar panel for me. Now, I'm not an expert, right? I do not understand the technicalities and you will be designing it, right? That's why I've come to you. But let's say you ask me ultimately, that Archana, the solar panel can be made of material from China. It can be made from another material. These are the options, which option would you like? And I kind of sign off on a particular option, or you kind of ask me to kind of accept the design, right? So if I'm involved even in this decision making, then I can actually say, because there were certain decisions which went into the designing, and therefore I don't have to be involved in the designing like an expert. But if
I'm not a technical person, so I won't have that kind of expertise. But
let's say if there were various options and I've signed off, this is what I wanted, out of material, so and etc., which impacts its the efficiency and the productivity or whatever, if I sign off on those, then of course I'm involved in the designing of the asset. So in the solar panel, like I said, everything is predetermined. Okay. So if I can demonstrate that I was involved in the designing of the asset, then it'll become a lease. Otherwise it'll become a service contract. So can you see the big difference?
Yes.
Just that answer takes you off balance sheet or on balance sheet. So similarly, yeah. So I think this is where I would look at. Similarly, if it was any other asset where, let's say the asset is, the use is predetermined, and let's say I was, the decisions are predetermined and I was not involved in the design, then I will see who is operating the asset. Okay.
Correct.
So there are many, I think maybe we can move on to another question. And
because
there are many other examples on lease definition, frankly, which I would like to, time permitting, like to take, because like I said, it's very critical. Because the off balance sheet, on balance sheet would be determined by this. And secondly, the reason I want to take it is because many times you don't even think that this transaction can be a lease. So just 10 seconds just to mention, for example, if I am, the LPG gas cylinder that you get, you use it, then you go get it refilled, you use it again. Is there a lease? People tend to don't think about it. If I get a storage container, let's say Pepsi gives me a storage container and I keep on using it or whatever. Similarly, your internet last mile connectivity where the cable is being laid down for you, and then you are going to decide the use of. So there could be many wherein lease could just come in and we don't tend to think about it in the normal course. So I'll be happy to talk about it once we have more time available.
Sure. In fact, continuing with this only, in addition to, right to use and then right to operate, right to ownership is the third dimension that I would like you to address, because it's related to this particular discussion that we were having right now.
So this is what I was in the examples I took, Asta. So if you look at the one that I spoke on, the ship, etc. What we are saying is that it need not, the standard is saying you don't need to have right of ownership, because if you have right of ownership, it will become PPE.
Correct.
Property,
Correct.
plant and equipment.
True.
So the standard recognizes that you may not have risk and rewards of ownership. Okay. But do you have right to use? So let's say if the asset has a useful life of 20 years, I have a contract for 5 years. Of course, I will not have the ownership risk and rewards, right? Because at the end of 5 years, there's so much of residual value. I don't have the residual value risk, right? But during that 5 years, who's using that asset? It is really not an asset of the supplier, because during that 5 years, let's say if you're the lessor, can you do anything with that asset?
No.
You can't, right? So therefore, the question is that who should be showing this as an asset? An asset is something from which you get future economic benefits. If I, as the lessee, have the right during that 5 years, let that right come on the balance sheet. So we are saying, we're not talking about ownership. We're talking about right of use, which means during that 5 years. Okay, in the example I took, who can use the asset? And if I have the 3 criteria which I had mentioned, if that is met, then I would be recognizing the lease.
Great. So this is, I think, very critical for the accounting perspective, that the ownership may or may not be there. Usage is more important. So going on to Kaleshwar sir, I have a question with you. In an arrangement, how should the payments for lease be segregated for payments for any other arrangement? I'm talking from lease perspective.
Okay, as discussed in the previous session, where Archana has pointed out, so wherever we basically ascertain the lease and segregate it from service or other arrangement, and only those gets accumulated. So once we establish whether it's a lease transaction, whatever payment which has been made in relation to the lease transaction, so one could be fixed lease rentals, variable lease rentals only if it is related to price index. Let me give an example here. Okay. I have agreed to pay in relation to bank interest just to match the market expectations. So that is also get clubbed as a part of lease rentals. The third is, if I have agreed to pay the residual value, even that gets clubbed. The next aspect would be, there could be an arrangement wherein I agreed to restore the asset to the original condition as a part of a lease agreement. Okay. So simply put, whatever has been agreed in terms of a lease agreement, which is paid by the lessee to the lessor, will get accounted or grouped as a present value, as a lease payment, and the present value of that would be arrived and recognized in the books of accounts.
Okay, thank you for the examples also. Continuing with the previous question, do we have any recognition exemptions in lease accounting? Also, what is the treatment in case lease contract has lease and non-lease component?
Fine, I think this has 2 questions. Let me address it separately.
Sure.
So coming to lease and non-lease component, let us understand this with an example. I have taken a vehicle on a lease. Along with the vehicle, I even get a driver services. One example. The second example is, I have taken a machinery on a lease. The supplier has also given the maintenance of machinery. So now the question is, the vehicle or the machinery, as the case may be, is a perfect lease contract. The driver services or the maintenance service is actually a service agreement. So what we're supposed to basically do is, we are supposed to ascertain the stand-alone price of the service and segregate that and account those separately. So this is what we normally do. However, Ind AS has given us a liberty. It has given us an accounting policy election, wherein a lessee can choose to go for, instead of bifurcating lease and non-lease components, you can choose for an accounting policy election, wherein you can go and recognize it as a one lease element. So wherein both the payments made in relation to rental of a vehicle and a driver's salary clubbed together will get accounted as a lease rental. So this is one accounting policy, which benefit has been given to us. The caution is, I need to use this for all the class of asset. So I cannot just use one this policy election for one lease rentals, and for similar lease contract, I cannot opt to go for a bifurcation. If at all I have elected, I need to elect it for all the class of asset. So this is one thing. So one more good news is we have two exemptions which have been given by 116. It was not there earlier in AS 19. So one is short lease contracts. So what is short duration lease contract? Any lease contract which is entered for a period less than 12 months. Those are called short duration lease contract. So there, the accounting standard has given us a liberty to not to opt for lease accounting per se. So I can basically recognize it as my rental expenses and get rid of it. That's the first aspect of it. The next exemption is basically small value assets. So here we have to be a little careful. What are small value assets? The standard is talking in relation to the assets which are high in volume and less in value. Say, for example, a company might take 1,000 laptops for its employees or 1,000 mobiles for its employees on a lease. So these are classical example of high in volume, less in value. So again, what the standard gives is, if at all it's small value items, then even then I can go for an exemption. That means I know I don't have to recognize this as a lease accounting. I could recognize it as a normal rental expenses without getting into the aspect of ROU of an asset and a lease liability. But caution again is this has to be done case by lease basis. Say, for example, 1,000 laptops into 10,000, the value will be certainly higher. But what it says is it has to be a lease by lease, and accordingly I can elect the exemption and still escape the ambit of 116 and recognize this as my normal expenses. To conclude, so we have two exemptions. One is for a lease contract for a period less than 12 months. So we call it a low or a short duration lease. Short duration contract. And the second one is less value items. These are the exemptions what we have. And the initial one, what we discussed, is basically accounting policy election, wherein instead of bifurcating the lease and non-lease components, I can elect to club that and show it as one lease contract.
Thank you. Next question would be on the treatment of incentives forming part of lease arrangement as per Ind AS 116. Sir, it's for you only, Kaleshwar sir. Yeah.
Okay, sorry. So basically what happens is, as we discussed previously, whatever the payments which a lessee makes in relation to a lease contract will form part of the total lease payments. There could be some example wherein I opting it for the supplier assets, there might be requirement for me to incur some additional expenditure. So what will happen is the lessor might compensate me by way of a reimbursement or incentive. So in that case, this reimbursement, the income, the incentives, what I'm going to get from the lessor will be shown as a reduction from my lease payments, and it will be treated, it will be reduced from my lease payments, and lease payments would be ascertained accordingly. To answer your question, if at all I have any incentive or a reimbursement of expenses, that will be shown as a reduction from my lease liability.
Okay. Thank you. Going on further, Archana ma'am, I have some questions for you. First is, what is the significance of lease term under lease accounting? What is its importance?
Okay. So lease term, of course, is just like under Ind AS 17 or AS 19. Lease term, of course, is important because that's the period over which you will recognize your, you'll do the accounting or recognize your lease expense the way as per the model. Now, the other reason why, if you ask me, the lease term is very important is because it impacts now under at least Ind AS 116, the amount of liability you will recognize. So let's say if I say my lease term is 3 years, I will recognize a liability of the payments I have to make over 3 years. If I say my lease term is 6 years, my liability will be higher. So in a situation, let's say you've got a 3 + 3 + 3 contract, you've got a lease term, which is, you have a renewal option at the end of each third year. So 3 + 3 + 3. If I say lease term is 3 years, my liability is X. If I say it's 9, of course, it will be much more. So, again, the two very big judgment areas which come in is first the lease definition, because like I said, it decides off balance sheet, on balance sheet. The second area where you see a lot of debate is on lease term, because like I said, it would impact the quantum of the liability. So like Prasad explained, those are the components of lease payments I will factor in. But do I factor in those lease payment components for 3 years, 6 years, 9 years will significantly impact the value of my liability. So that's the significance of a lease term. Now, lease term has had, and because of this reason, because it impacts, many questions are now coming up. See, earlier because many leases used to be operating leases, so companies didn't really matter so much because of the lease term, because the rest, it all went into disclosures. Of course, you had to give maturity analysis, but it didn't affect your current year expense in that sense, in all the cases, unless until, there were escalation clauses and so on. So I think, therefore, now when you see companies applying the standard, you see a lot of questions coming up on lease term. Okay. And sorry, I know I'm just going a step back, but maybe even on the lease definition, since I just referred to it, when we were initially implementing the standard, this question, just like you said, is there going to be a big change in terms of lease term, etc., the relevance?
Right.
The same question came up even for lease definition. So we said, let's say if in India 17, I had recognized 10 contracts of the company as lease, okay, would I expect to identify more? Okay, would more fall into the definition of a lease? So initially, when the standard came in, many felt, no, the definition was already there. Definition is largely similar. Of course, you've got nuances, but probably it shouldn't change much in terms of the population. But the experience showed that companies spent quite a bit of time in identifying whether or not there was a lease, and actually the population of leases may change. And the same is true for lease term. Okay. While largely the concept hasn't changed, if you ask me. Okay. Right. Lease term as a concept was there. It is there now. There are some nuances for it, and I'll just take you through the lease term definition. There were some bits which were in detail in Ind AS 17. There is more detailed guidance in Ind AS 116 in terms of how that lease term will apply, and there are more terms which are being used. So yes, definitely, while the relevance of what is the lease term continues, but there are many more detailed nuances for the reasons like I mentioned, because it impacts the measurement. So again, in fact, IFRIC had also dealt with the issue of lease term in that context, because of the number of issues which came up, because each agreement will have their termination options, renewal options. You have, you hear terms which are called cancelable leases, evergreen leases, renewable leases. What are these and how do you really take them into account? So that is where the questions came up. Now, if I was just to talk about what the lease term is, okay, the lease term, it's the way the standard defines, it says that the lease term is non-cancelable period of the lease, together with any optional period that the lessee is reasonably certain to use. Now, frankly, if you ask me, this bit was also there in Ind AS 17 or AS 19. But let's see what has changed. So again, sorry, I'm going to use the presentation because, I'm going to use 3 terms here. When you look at lease term, there is a concept of non-cancelable period. There is a concept of lease term, and there is a concept of enforceable period. These are the 3 concepts the standard uses. And let's just try and understand this. So non-cancelable period, if you were to ask me, effectively is the minimum lease term. It is not the lease term, it is the minimum lease term. So non-cancelable period is a period during which the lessee does not have an option to terminate. So I am in a way locked in. Okay. So let's say I have a contract which is 3 + 3 + 3, but in the initial, when I say 3 + 3 + 3, there is a renewal option. But in the initial 2 years, I cannot cancel. When I say I cannot cancel, we'll also discuss what non-cancelable means. Okay, but I'll come to that later. So non-cancelable period will be 2 years in the example I took. Okay, and let's say after 2 years, I can cancel with no notice period. Okay, so if I can cancel without any notice period after 2 years, but for 2 years I can't cancel, non-cancelable period is 2 years. That becomes my minimum lease term. Now I'm going to first go on to the concept of enforceable period. What is enforceable period? enforceable period, as the name suggests, is the period during which and I'm not giving a technical definition, I'm just giving a layman's understanding, is that it is a period during which you can enforce your rights and obligation. So let's say in the example I took of 3 + 3 + 3, the agreement gives me a right of renewal. So if I exercise the right of renewal, the lessor is obligated to renew. And let's say if the lessor refuses, I can enforce it, which means I can go take him to the court and then still enforce, right? So enforceable period means the period during which legally I will have, legally or contractually. And I'm making a distinction, very conscious distinction between contractual and legal. Okay. So either contractually or legally, I can enforce my rights and obligations. So effectively, the enforceable period becomes the maximum lease term, which means your lease term cannot be less than the non-cancelable period, but it cannot be more than the enforceable period. Okay, it'll be within this range. So let me take the simple example of 3 + 3 + 3, which I was talking about. So minimum period becomes, I said that I do not have a right of cancellation for 2 years. So my non-cancelable period becomes 2 years and no notice after that. Okay. My enforceable period in the example I took, and this is a contractual arrangement, I can enforce it in court of law. So my enforceable period will be 9 years. Okay. Beyond that enforceable period, there is nothing. Okay. There is no contract. You have no rights, etc. Now, what is my lease term? My lease term, like I said, minimum 2 years, maximum 9. Now, what I will do is I will look at after this 2 years non-cancelable period gets over. Do I believe I will I continue? So what is the word that we use? We said any renewal options which the lessee is reasonably certain to exercise. And this was there even earlier. Okay. So you factor in those things to look at. And let's say if I'm just taking a very simple example. Let's say that when I took this property, this 3 + 3 is for a property. When I had taken this property on lease, I had constructed leasehold improvements. Very expensive. I had put in a lot of money on that. And the useful life of these leasehold improvements is, let's say, 8 years. Okay. So that tells me that I will not invariably move out till 8 years have gone. Or let's say there could be many other factors. Let's say I tell you that leasehold improvements are significant. I also say that this is, this property is in a location which is a very, like a strategic location, in that sense, it attracts the right and a high level of customers and so on. The renewal options which I have, the rate which I will have to, the rent which I will have to pay on renewal is at a discount to the market rate, which is expected to be, during those years, right? So if I look at all of these, I can easily conclude that it is reasonably certain that the lessee will exercise the renewal option, and therefore it will become 9 years, right? Now, this is how, and it's the example I'm taking is very easy, but usually it will not be that easy. A lot of judgment comes into the picture. Now, I'll tell you why this issue went to IFRIC. Okay. And again, like I said, just I know at the cost of repeating, it's because of the liability measurement. Now, when we were looking at non-cancelable period, okay. So the question was, how do you calculate non-cancelable period? The way the non-cancelable period is defined is it is the period during, so basically it is the period not the non-cancelable, the enforceable period has that. Enforceable period, when you look at the definition within the standard, it talks about the period, during which you cannot move out without any, it's only when you can move out with any non-significant penalty that can you say that it need not be taken into account for determining the enforceable period. So the fact that there was reference to penalty for determining the enforceable period, and that also impacts how you look at the non-cancelable period, the question came up, what is this penalty? How do you understand the term penalty? Okay. Now, let me take a very simple example. Let's say if I say that after 2 years, I can cancel the agreement, and there is no stated penalty. Okay. This is the example I took in 3 + 3 + 3. I said, but 2 years after 2 years, I can cancel with no notice period. And let me also say with no penalty. Okay. So the question was, how do you factor in penalty? Should I only look at when I'm making this decision of enforceable period, non-cancelable period, reasonably certain to exercise? How do I factor in penalty? Okay. Because if penalty is very high of canceling, then the conclusion is that the lessee will not exercise the decision to terminate, right?
Right.
So one way of looking at penalty is you just look at the contractual penalty, which is stated in the contract. The IFRIC said that is not the right way of looking at it. We are not talking about payment of penalty. Payment of penalty would mean the cash out. Okay. But here the concept is using the word just penalty, not payment of penalty. So they made a distinction between the two. And they said penalty would therefore be any disadvantage. So let's say if I was to terminate, and the leasehold example I took, I would lose those leasehold improvements. That leasehold improvements, the loss of leasehold improvements will be also considered as a penalty.
Right. So too expensive. I spent so much on it and then I lose it. So
yes. So the point that IFRIC made is that when you're looking at penalty, it is on any economic disincentive. It can be cash, it can be other than cash. So determine when you're looking at enforceable period, etc., determine look at the penalty, not just from a cash perspective, but also from economic disincentive perspective, and then determine your enforceable period. And similarly, obviously, once you've determined your enforceable period, you can also determine your lease term, because lease term cannot exceed enforceable period. So in the example, I do not know whether my concern came out clearly. If I was to, in the example I took, I said after 2 years, there is no stated penalty. Okay. Then one could argue that lease enforceable period is also 2 years.
Right.
If I was to take a very narrow meaning of penalty, then one would say my non-cancelable period is 2 years, my enforceable period is 2 years, and therefore my lease term cannot be beyond 2 years. So this is where IFRIC said, they said, no, you will not just look at cash penalty, you will look at economic disincentive. And the economic disincentive in the example I took was that you will lose the leasehold improvements. And that is why it took your enforceable period to 9 years.
Correct.
Okay. Are you getting my point in terms of
basically, I mean, the lease term has impact on the penalty aspect also. They go hand in hand.
Otherwise, my enforceable period would have been only 2 years. If I had taken a narrow definition of penalty. So the point is that penalty has to be interpreted in a broader context, and then you determine your enforceable period, and that also indirectly impacts the lease term. Let me just take 1 or 2 examples of, these are very simple examples, but let's go through it. Let's say you've got a lessee which leases a retail store. The written contract is for a maximum period of 5 years. Both the parties, B and C, have a right to terminate at the end of year 2 with no more than insignificant penalty. And there is no right which the law gives you. In certain jurisdictions, even contractually, if there is no right of renewal, the law gives a right of renewal actually. Okay. So let's presume in India, this is a case of India where there is no such legal right. So in this case, clearly the lease term would be 2 years. It's a very simple one, and I'll come to a bit more complex. Similarly, in the next one, the written contract is, let's say, for 5 years. And after year 1, both have a unilateral right to terminate the lease, but a notice of 1 month is required. Okay. Now, and if you look at it, if the lease is terminated, nobody suffers more than an insignificant penalty. Okay. So in this case, the lease term would be the non-cancelable period. If you look at it, the non-cancelable I'm talking about will be 13 months, not the lease term. Sorry, in both I was talking about the non-cancelable period. So the non-cancelable period in the first scenario would be 2 years. In the second scenario, the non-cancelable period would be 13 months. Now, you could also have situations where the leases have no stated term. So let's say the lessor has leased an equipment to the lessee. There is no stated duration. I can terminate the lease at any point of time. So it's like this is what I was calling an evergreen lease. Okay. So I can just return it at any point of time. For every day I use, obviously I have to pay for it.
Correct.
Now, obviously, I mean, in this case, you will actually have to exercise judgment to determine the lease term. If, let's say, if I was the lessee, I would actually see what is, till when do I, what is the economic incentive or disincentive for me to continue with the asset? And based on that, I will have to determine a lease term. But let me put it like this here. This is the non-cancelable period. If you were to look at it in the example on the slide, is just 1 day, because I can cancel at a 1 day notice.
Correct.
But my lease term would be, obviously, I don't expect to use the equipment only for 1 day, depending upon the significance of this equipment to my business, how integral this is to my business, and so on. And, so basically there could be many factors basis which I will look at the lease term. And let me put it like this: the shorter the non-cancelable period, something like this, the higher the possibility of renewal, because nobody will just take something on lease for 3 days or 4 days or whatever. So these are some easy examples. There could be, so this
I think, let's go to the next part. So in continuation, this only is a requirement for reassessment of lease term during the tenure. Like what factors, lead to reassessment of the term?
Okay. So I think I was on that only.
Okay.
This one is actually a very important difference. Let me put it like this vis-a-vis Ind AS 17 or AS 19. Okay. Now under Ind AS 17 or AS 19, you could, let's say, I'm going back to this simple example I took of 3 + 3 + 3. So I at inception thought, I would not exercise the renewal option, and therefore I took the lease term to be 3 years. Okay. Now at the end of year 2, I felt, let's say, because the reason I felt that I will not renew this is because, let's say, I have set up a restaurant in a new location. I don't know whether it will be successful. I think I will see how the business goes. Too much of uncertainty. So I decided it is 2 years. But my initial 1.5 years tells me the business is doing well, it's picking up, and, my business decision, at least if I look at my expectation is that I would continue. So under AS 19 or Ind AS 17, you could change or reassess, and factor this decision and change your lease term. But that is not how it works under Ind AS 116. Now, Ind AS 116 has 2 paragraphs which deal with lease term reassessment. The first one, which is there, if you can see the slide, refers to a lessee. Okay. The reason I'm emphasizing is because that paragraph then can only be used by lessee. Okay. It cannot be used by lessor. The second paragraph, which is para 21, uses the word an entity, which means the lessor and lessee both can apply para 21. So let's say I'm a lessee, okay, and I'm going back to the same example, 3 + 3 + 3. I decided initially I will not exercise the renewal option. I took the lease term to be 3, okay. Now, at the end of year 1 or at the end of year 2, can I just decide, no, now I feel the lease term is going to be 6 or 9? The answer is not that easy. So if you'll see, the standard says effectively, I mean, I'm not going to read the paragraphs, but effectively it now requires a business action or a decision to be taken. So let's say just on mere market expectations or my expectations or intent, I can no longer reassess. Correct. So let's say that in the example I took, I have reached the end of year 2 and I give a notice to the lessor saying that I will be renewing at end of year 3. Okay. So once I have taken an action, which again, I'm using some words just to explain, which are not there in the standard. Let's say I've taken an action which effectively then is not reversible, which says that the company is committed, right? So if you see para 21, it says the lessee exercises an option not previously included. So which means I should have exercised, not my intention, not my expectation. So if I think I will exercise, but I have not given the notice, then I don't do a reassessment.
Okay.
Similarly, let's say something that could get covered in para 20, okay, is that, let's say initially when I had taken on the premises on lease, I had not done too much of leasehold improvements. I said, let's just see how things are. I had done a very basic arrangement. Maybe it was my head office, maybe it was my factory, whatever. But as and when the period passed, I actually put in a lot of leasehold improvement. And that actually is an action which I have taken. Okay. So effectively, the point I'm making is that there has to be a business decision which you have demonstrated. In a way, when I say demonstrated, means you're committed to it. Only then can the lease term reassessment happen, and I know I'm taking a bit of a time on this, but this is important because I've realized that many have not appreciated this difference in the standard. So I'm just going to take an example to illustrate this as well.
Sure.
But this becomes important because, and I'll tell you why, when you go to the basis of conclusion, initially when I read the standard, I felt, why it's very strange when my business, when I know my intention is changing, why am I not asked? Why am I stopped from kind of doing a reassessment? Is my liability not understated? Right? I know I will exercise. Of course, companies are happy because that way their liability is so they have no issue with this. But when you look at the standard setter, the standard setter said their intention is actually to make the standard easy in terms of cost and effort for implementation. So they said if we would have left it like it was earlier, every year the lessee will have to demonstrate whether or not the estimate of the lease term is changing. Okay. Here, what they have done is they've given a higher threshold. So this, in a way, from a cost and effort perspective, they said every year the lessee will not be required to do it, only when there is a trigger of an item which is there in para 20 or 21 that you land up doing it. Okay.
Right.
So they said instead of making it difficult for them or asking them to do it year on year, they will be only required to do it when an event which is covered in para 20 or 21 takes place. So that is where the standard setter actually has tried to kind of ease the implementation. Let me just quickly take this example. Let's say there is a retailer which has leased a shop from a landlord L. There is a non-cancelable term of 5 years, and the lease can be renewed for the further period of 5 years, which means it's 5 plus 5. So its enforceable period is 10 years, which means the maximum lease term is 10 years.
Right.
At inception, let's say the lessee was not sure that it will exercise, therefore it took the lease term to be 5. Now, during year 3, in the example, this is similar to what I took. The premises underwent significant rebranding. There was a lot of significant leasehold improvements which were installed. And those leasehold improvements had a life of 10 years. Okay. Now they cannot be moved and so on, because if I was to, take them out, etc., they will get damaged. And this decision of installation is an evidence that now I will renew. So even though I have not given no notice to the landlord, but this significant leasehold improvements will support the para 2021, and this will fall under para 20, and you will be able to reassess your lease term. And just one more minute, taking a slightly different example, wherein let's say I have a retail store, which is for a non-cancelable period of 5 years with it's 5 plus 5 plus 5. Okay. Basically a renewal option at the end of every 5 years. So initially I concluded that renewal option not reasonably certain, just like in the previous example. So I took them to be 5 years. Now here, I have not in year 3, I have not taken any decision or action, but in the locality, in the area where my retail store is, there is a lot of renovation happening in that area. Because of the renovation, the price of that market is, the price of that property, and therefore the rentals are expected to increase. I will have a cheaper rental property. The consumer traffic is expected to increase, etc. Now, and therefore I feel that, okay, now I believe I will exercise the renewal, but I have not given any notice to the landlord. In this case, you cannot reassess. Because there is no significant event within the control of the lessee. The lessee has not really taken any decision. The renovation of the area outside is not within my control. And like I said, your mere expectation or market-based factors do not impact the lease term assessment.
Very beautifully explained, ma'am. Kaleshwar sir, next question is for you. Under which circumstances should the arrangement of transactions be reassessed under Ind AS 116?
Okay, so basically what happens is, in a lease contract, all the decisions are being made at the inception of a lease.
Right.
So we don't wait for a period to pass on. We basically take a judgment at the inception of a lease. To explain this, say for example, we may opt for short duration lease contract. That means I basically decide not to extend this lease term for beyond 12 months.
12 months.
But it may so happen that after a period of 6 or 7 months, I decide to extend. I feel that I need to use this asset for a sufficient period of time. So initially, what I would have done, I would have opted for lease accounting. I would have been accounting it as a regular expenses. But at the end of 6th or 7th month, when I actually decide that I need to go for a longer duration, then the lease accounting comes into picture. So what basically happens is, so one thing we have to remember is this decision usually made at the beginning of the lease contract. That's the first thing. Now coming to the lessee and a lessor. Lessee, we basically go under Ind AS 116, we basically go with a single accounting model. It doesn't differentiate between operating and a financial.
Finance lease, right.
However, lessor still has to go for operating and financial lease. So it may so happen that, continuing the same example, initially he might have accounted it as an operating lease. Due to change in circumstances, he may have to rearrange or reassess it as a financial lease. So that could happen for various reasons. The reasons are there is a change in lease rentals. Classical example is like during COVID time, it so happened that people started negotiating and asking for a concession in the lease rentals. I would have initially recognized my lease liability, taking the original rentals into consideration, accordingly arrived at ROU of an asset under lease liability. So now the lease liability is getting modified because of the reduced lease rentals. One example. The next thing is, I may opt to buy an asset at the end of a lease term. So the value might also have to be added to the lease liability. So these are all the instances when I'm supposed to go back and reassess the value which I've established for ROE of an asset and a lease liability, and then have to do a reassessment. What the standard says is you're supposed to do this year on year. However, under these circumstances, as and when the circumstances arises, you may have to reassess and give a effect. So again, one more thing is, please note this. This is a change in accounting estimate, nothing else. So I will not be doing any retrospective effect. I'll have to do only a prospective effect by re-arriving at the lease liability and giving effect to the lease liability with a revised discount rate for a remaining lease period and giving corresponding effect to ROE of an asset.
Okay.
So then, yes.
Okay. So basically, then I'll also have to give a disclosure in the financial statements regarding the reassessment of the lease, depending on whatever changes that I've done.
Yes.
Great. Archana ma'am, next question is for you. Land lease is a very common practice in India. In fact, we have few questions from our attendees on land lease only. So please help us understand the application of lease accounting in land lease scenario.
Actually, if you ask me, and maybe it will help to understand where the participants have challenged. The issue of
can you read the question regarding land lease? Maybe we'll get a particular scenario to address. So whether industrial plot lease for 100 years allotment by RRICO is fixed asset in the books of SSE.
So
yeah.
Now, the point I was trying to make is it depends on whose angle are you looking at it from when you talk about land lease. When you look at it from the perspective of lessee, now it no longer makes any distinction. There is no distinction of finance lease and operating lease. So you will still do your lease term assessment. You will still do your recognition of ROU, etc. Now, and I'll come to the lessor, okay? But a very interesting question comes up. So I'm just going to take up this question only industrial plot for 100 years. Now, let's say in India, if I say that at times what happens is that even if I want to take ownership, legal ownership, the land doesn't come on legal ownership, it comes only on lease, okay? So very clearly the intention is to buy the land, but the government gives it, let's say, on a lease. So the question comes up is that, can I recognize it like the person has said as PPE? Because that is what it was intended. This is just a lease in form. But unfortunately, the way, under AS 19, if I recollect, the way the Schedule 3 requirements were, reading that together with Schedule 3, you could show that under your PPE. In the sense when you showed land, you showed leasehold land as well. So effectively, that came into your PP schedule. Can you hear me?
Yeah, we can hear you.
Okay. So, but when you look at it from the perspective of the standard, which is Ind AS 116 now, if it is structured as a lease, okay, the question is, do I account for it under Ind AS 16 or under Ind AS 116? It will have to be counted for as a under India's 116. So I appreciate that the intention is nothing but purchase of ownership, but it will go, as far as lessee is concerned, you still apply 116. The net outcome will be the same. There will be no difference. It's just that instead of leasehold land, you will be calling it an ROU.
Right.
But let's come to lessor. Okay, so this question actually is very important from a lessor perspective, land lease. In a way, some of the issues are not new. Prasad did speak about finance lease concept and so on, the operating and finance lease distinction. So because the lessor would still have to do a finance lease and operating lease classification, those issues do come up. So there are various, for example, let's say if a lessor is giving land and building, both, they have taken land and building both on lease. So should the lessor do a separate assessment for both, a separate assessment of lease classification for land and lease classification for building? Then there are also related issues. And of course, all of these will take time. Quite often, let's say if I've taken a building, proper premises building, of course, building will come with the land. It can't come without the land. But the service provider is also going to provide me maintenance services. So, let's say
there's some technical snag at your end, ma'am.
Building, I go to DLF now. And at times there can be, sorry?
It's better, it's
now,
fine.
Is that part of the lease? Yeah, is that part of the lease, this thing? Do I separate it as a non-lease? There are at times concerns because some of these have variable lease payment concepts as well. So how do you deal with this? Some of the other issues which come up in land and building leases is, property taxes or say VAT or this thing, who would recognize? So if I look at it, let's say if I'm a lessee, I've paid, let's say 1 lakh each month. And in addition, I pay that. For me, everything is part of the cost of using that property, right? But if the levy is on the lessor and not on the lessee, then it is, and what happens is I make the payment directly to the government. So if you look at the lease payment definition, the lease payment definition says the payment, it uses something to the effect that it is a payment to the lessor. Now, if I make the GST or the VAT payment to the government, I'm not making it to the lessor. Effectively, it is not part of your lease payments.
Okay.
So there are issues around property tax. There are issues around this. There are issues around, do I separate the two? There are issues around, maintenance activities. So when you look at the land leases, I think the issues are varied, especially from a lessor perspective. From a lessee perspective, yes, I understand the thing about taking it to PPE. I myself, frankly, when I first started, working on the standard, I was like, this is in substance of purchase. Even if it's in substance of purchase, if it meets the definition of a lease, you'll have to account for it as a lease.
Okay. In fact,
Prasad would like to add anything on this. Prasad,
yeah, so please, if you have any views on this.
Yes, Archana. So basically, I actually see it as a different thing. Land has got a perpetual existence. Okay, land has got a perpetual existence. So there is not a question that when I enter into a lease arrangement, so whether it's 49 years or 99 years, since it is going to have a perpetual existence, I cannot say that in substance I'm transferring my ownership, because at one point of time I'm going to get it back. To answer to what Archana said, as far as in the books of lessee, it is quite simple, because irrespective of the duration, I always recognize that as an ROU of an asset by recognizing corresponding lease liability. So in the books of lessee, it's always safe. I'll come back, just do remind me, I come back and add on this municipal tax and those kind of scenario. When it comes to a lessor, now the question is, since the land has got a perpetual existence, so do I fit into a financial lease? Can it ever be considered as a financial lease? The first question. Now, the next question is, not necessarily land gets leased, land along with a building. So which Archana also touched upon. So what basically happens is, we have to look at which has got a substantial value in the contract. Whether land has got a substantial value or a building has got a substantial value. That could be one of the decision factor for us to establish whether it's a financial lease or an operating lease. Okay. If it were to be land per se, then I would always prefer to go for an operating lease, because that element of transferring substantial ownership doesn't fit into. I would always account that as an operating lease. If it were to be land with a building has got a very negligible value compared to the land value, then again, I would fit into operating lease. There could be instances because of the commercial nature of the property where building takes a substantial value compared to the land. Then yes, looking at the time period of usage of the building, we could take the nature of operating lease. Archana could correct me on that.
If I can add, actually, this only goes to show the relevance of the questions, that views can be so varied.
Right.
I'll just add to what Prasad said. I have a different take. Let me take the three situations he said. Okay, I don't think it has anything to do with significant value, and the point he made is very interesting on the life of the asset, okay, the land. And now let me take you back to, in the beginning, when he spoke about the scope of standard, he said AS 19 excluded lease of land. Why did it exclude lease of land? There is a reason. Now because AS 19 was based on IS 17. On IS 17, okay? The way IS 17 was interpreted is what Prasad is saying. They said land does not, the value only increases over time. Unlike other assets, it never depreciates. It has an endless life. And therefore, they said that under IS 17 initially, they said land will never meet the finance lease definition, which is what Prasad is saying. And therefore, under IS 17, land used to be always operating lease. When we adopted the standard AS 19 in India, we did not really agree with it. We said in India, we know that in substance, it is a purchase. Okay. Like I said, the government only gives it on lease. So form should not drive the accounting. It should be substance. Absolutely. And that is why they kept it outside. So IS 17 did not exclude leases of land. AS 19 added that. And by taking it outside, then came the question that if I don't have to apply AS 19, how do I account for lease of land? Then there is an ESU opinion which effectively applied the same criteria for finance lease and operating lease and said 99-year leases can be finance lease. Now, this was an issue which was not just in India, in many other jurisdictions. Over the period, and maybe just a few years before IS 17 was replaced, even IASB recognized it. So IASB initially had said that land lease can never be financed. They revised that position. If you look at their standard, they revised it. They said land lease can be a finance lease. But of course, they were very smart. The example they took the lease term to be something like 900 years or whatever. Obviously, typically will not have it that long. But the fact is they made a big change in their thinking, wherein initially they said land lease can never be financed. They acknowledged and they said you have to look at jurisdiction-specific conditions. So, but my point is, we didn't really agree with this as a concept even earlier that land lease can never be financed. That is why we had a scope exclusion, which was not there in IS 17. So I think you could very much have land lease being classified. And to Prasad's point, his point is not really, I'm not saying really not right, or I'm not disagreeing totally. I know there's limitation of time, but this is an important point. Let me take two situations. One is I say that the land lease in 99 years. And after that, I have a unconditional right of renewal. I don't need any approval. It will automatically be renewed. And all that I will pay is 1 rupee. So there we said, as a country, we said this is nothing but an in-substance purchase. And we feel this can easily be, because anyway, rupee 1 is a bargain renewal clause, right? And therefore we said if it's a perpetual renewal at rupee 1, we feel it's a finance lease, and we feel even ISB would accept that. The second is a situation wherein I say after 99 years, it's mutual agreement. Okay. The renewal is at mutual agreement. The other party can refuse, or the renewal will be at market rate, or the renewal will be at mutually agreed rate. Then probably the answer could be different. So if you see earlier, the way the land leases used to be, the government would give you 99 plus that endless renewal at 1 rupee. But recently in some of the areas, okay, they started changing where they said at market rental or subject to, mutual agreement and mutual agreed rate and so on. So the answer could be both ways. But the point I'm trying to make is land lease can be finance lease. It is not that it cannot be. And let's say if I have a land and building, I would actually make the same assessment. So let's say if the lease is for 10 years only, and the useful life of the building is 40 years and land, of course, then of course, very clearly an operating lease from a lessor perspective. But let's say the lease is for 30 years, or let's say not 30, 40 years, and the useful life of the building is 40 years. Then I would say building is finance lease, land I would take operating lease. Okay. But or let's say I have a situation wherein it's 99 plus perpetual renewal together with the building, then both are on finance lease. So I think there can be various permutations and combinations in that context.
So
just
I have
to add on to that, I think even Transfer of Property Act, which provides for lease of land, I think knowledge of that would also add to give a clarity here.
Of course.
And the other point which Archana has pointed out is in relation to municipal taxes. So there could be two instances where I am paying municipal taxes as a part of the lease contract. Or the second thing is I am paying and I'm getting it reimbursed from the lessor. So that would help to determine whether it will actually get into a lease payment or not. If I'm paying it as a part of a lease contract, in a sense as a part of a maintenance, then it would go as an indirect expenses in my P&L account. It will not get accounted as a lease payment. However, it is getting reimbursed in the sense as a part of a lease contract. I'm getting it reimbursed from the lessor. Then I think that could add on to the lease payment calculation. Am I correct on this front?
Okay. I think that too. So, okay. Shalini, there's one more on the lease bit, on the land bit. Should we cover that as well? I think that's a very interesting one. On the upfront payment.
Yeah, I was about to read that question.
So, there can be situations. One is like we've been talking about a 99-year lease wherein we are saying, let's say I make a payment every year. Now, quite often where the intention is actually an in-substance purchase. So whoever's put in this question, it's a very good question, where typically it is a finance lease. Typically you will not have, I'm not saying it can never be, but I'm saying generally you will never have annual payments because the intention is purchase. If it is in substance purchase, then usually you will make the upfront payment. So you will have a bullet or a balloon payment, as they call it, right in the beginning, and maybe very nominal payment of 100, 1, whatever, over the 99 years. So actually, if you have an upfront lump sum payment, which is equal, let's say, to the fair value of land as on that date. So let's say today I'm interested in buying the land, but legally, I can only get it on lease. The law does not permit, or let's say it's from the government and the government just gives that land only on lease, not on a direct sale. So, but what I have done is I have paid this upfront payment is equal to the fair value of land on that date. Then obviously it very much is supportive of a finance lease from a lessor perspective. And that is how it would be accounted. But like I said earlier, unfortunately, you will not be able to kind of say, I'm going to take it to Ind AS 16. It will still have to follow the requirements of Ind AS 116 with all the relevant disclosures, accounting, and so on.
So moving on further from land lease accounting, Kaleshwar sir, I have a question for you. What disclosures should be kept in mind both under AS 9 and Ind AS 116 in the financial reporting? It's a very important element. I think everyone should know about this.
See, basically what happens is that whatever the information I'm giving in financial position and financial performance, that need to be elaborated upon by way of a notes to accounts. So that could be like a P&L item. What are the things which gets hit my P&L account item, which is basically the depreciation, the lease payments, the contingent rent, if any. So instead of discussing each and every element, so let me give a broader picture as to what are the items which gets disclosed in notes to accounts. So the one is in relation to in the books of a lessee. The one is in relation to, say, if it were to be AS 19, basically operating lease or financial lease. So three important elements is what I would like to concentrate as far as AS 19 is concerned. I'll tell you why, which this is important little later. They want us to prepare something called as a reconciliation. So the reconciliation in relation to my lease payments, that means how I have arrived at my present value of lease payment. Basically, the total lease payments having discounted at increment or discount rate. So I will arrive at a present value of lease payment. So the reconciliation statement is what they expect us to prepare. In addition, just like we prepare this debtors aging analysis in the company's schedule.
Hmm.
We are also supposed to prepare a schedule providing for what is the lease payments due for next 1 year, due between 1 to 5 years, and which are supposed to be paid later than 5 years. So this reconciliation statement also need to be prepared. First thing. The second thing is basically with respect to if at all I have a sublease. I'm basically a lessee, but what happens is I've actually sublet it. So the details of a sublease as to what are the rentals which I'm going to get, what is the duration of it, the details of the sublease. And the third one is with respect to disclosures with respect to the contractual agreement, specific points in relation to the lease contractual agreement. What could be that? Is there any escalation clause? Is there any clause in relation to buying an asset at the end of the useful life? Do we have any restrictions and covenants for usage of an asset? Yeah. So these are some of the disclosures which has to come. So this is what we do it in AS 19. This is in addition to whatever we have calculated. If you have calculated, so it goes on very detailed, saying that what is that asset, what is that asset which you have taken it on lease, how you have to show it separately from other assets as per accounting standard on fixed assets. So with respect to lease liability, how we have arrived at a lease liability, what are the components which has gone onto lease liability. With respect to P&L account, both on the income and expenditure side, anything in relation to lease rentals have to be given. In addition to that, these 3 points which I've just elaborated, one is reconciliation statement. The second one is details in relation to sublease. The third one is respect to the general disclosures in relation to, specific disclosures in relation to this lease contract. So this is what is required to be disclosed as far as accounting standard 19 is concerned. When it comes to accounting standard Ind AS 116, what it says is you have to disclose such information in relation to lease so that the readers of the financial statement understand the impact of the lease on the financial position, financial performance, and cash flow statement. Basically, it is saying that wherever you have a lease getting affected in your balance sheet, in your profit and loss account, and cash flow statement, you're supposed to elaborate that and discuss in detail. So they've even gone ahead and further classified that into quantitative disclosure. That's basically how we have arrived at a number and similar details, quantitative aspect of it, qualitative aspect of it. So qualitative aspect is basically if I am supposed to pay variable lease rentals. So what is the basis for that variable lease rentals? If I have any restrictions or covenants for using those assets, such other qualitative details have to be made available in the second instance. The last is basically the general disclosure. We can relate that to what we discussed in accounting standard 19. So basically, whether I am what I'm doing, is it on par with the industry practice or is it deviating from an industry practice? And similar kind of specific disclosure in relation to my accounting. So this is in a nutshell as far as disclosures are concerned. Let me reiterate. See, basically, whatever number we have given in the balance sheet, profit and loss account, cash flow statement need to be elaborated, need to be explained in detail by your notes to accounts.
Right.
Accounting standard 19. In addition to that, those 3 things. One is a reconciliation statement. Next is relation to sublease, and the third is relation to specific disclosure in relation to lease contract. Coming to the Ind AS 116, they have basically grouped it as a quantitative, qualitative, other disclosure. Yes.
Thank you. Archana ma'am, can you please throw some light on the concept of sale and leaseback transactions with examples, and also give us a comparison between AS 19 and Ind AS 116?
Okay. I don't have an example on this one because it'll be I could have, but it's a very detailed calculation. But let me just share the concept, okay? And we need to appreciate the thinking in the standard. If you recollect, AS 19 talks about sale and leaseback. What is sale and leaseback? Effectively, I'm selling the asset to the buyer, and then from that buyer, I'm taking the asset back on lease. So the buyer becomes the lessor, and I am the seller, I become the lessee. Okay. Yes. Now, why is this usually done? There could be various genuine reasons. Let's say maybe I have an asset, I need funding. Okay. And I feel I don't even need the asset has a 10-year useful life remaining. I feel I need the asset only for another 2 years or 3 years. So why be loaded with the entire? So I sell the asset and then I take it back on lease. That way I'm only now required to pay for the 3 years, and the remaining value I'm able to leverage. So if that is the case, this would usually be a sale and of operating lease back. But AS 19 also acknowledged that you could have a situation of a sale and finance lease back, right? Now, if you think about it, why would anyone do a sale and in a sale and finance lease back? Nothing changes. On one side, I'm selling, and when I say it's a finance lease back, in finance lease, you take the risk and rewards of ownership. On one side, I'm giving, on the other side, I'm taking. So why would anyway, I mean, there is really no commercial substance in that. And typically this is done to get financing. So I sell it, and when I do a finance lease back, effectively the asset becomes as a security for the money that I get. Now, at times this sale and finance lease back may not be at arm's length. And then the standard said, and let's say my carrying value of the asset was 10 lakhs. I sold it at 12 lakhs. Okay. Or let's say 15 lakhs, where the fair value is 12 lakhs only. So by selling, and I was trying to recognize it was 10 lakhs, I sold it for 15, and I'm trying to recognize a gain of 5. But the true gain is only 2 lakhs, the fair value. So the standard said, if it is above fair value, then do you recognize a gain or not? Because obviously, why would the counterparty buy it at a higher value? Which means I will have to pay higher lease payments. Somewhere it will go back. So which means this gain of 3 lakhs is not really realized. So AS 19 dealt with situations of sale and operating leaseback, sale and finance leaseback. It had specific guidance on sale and finance leaseback, if it is at fair value, not at fair value, and all those things. Now, when you come to Ind AS 116, while it recognizes still the concept of sale and leaseback, it makes a very interesting point. It says, for something to be sale, it'll have to meet the sale condition under Ind AS 115. Let's say if I had an item and I'm selling it, and so they said, if you have sold it, okay, let me reword. Let's say if you've taken it back, if you're saying it's a finance lease back, which means the sale never took place. If you are, again, let's say so-called I'm saying I've sold it, but I've taken it back on finance lease. Finance lease would mean I still have the risk and rewards. The standard Ind AS 115 uses the term control. Okay, and risk and rewards is just one of it. Okay, so they're saying if it's a finance lease back, effectively, which means control was never given up, because physically you have it, risk and rewards you have it, and chances are the sale never took place. So it's a very interesting point that they're saying you cannot really effectively, usually you will not, if the sale criteria is met, okay, if the sale criteria is met, then only can you have some kind of a lease back. If the sale criteria is not met, there will be no lease back.
Okay.
So chances are, I'm not saying it can never be, chances are that having something like a sale and a finance lease back, we don't expect that really to be there. Now, can I say it will never be? Obviously, we are still in an initial period of implementation. Can there be certain situation in which you can still have a sale and finance lease back? I can't rule it out. But generally, the understanding is that the concept of sale and finance lease back is largely gone with Ind AS 116. So you will typically only have sale and operating lease back. That is what is expected. Now, let's see, how do you account for the sale and lease back, the other bit which it makes a difference. So let's say I'm going back to the same example. I had an asset of 10 lakhs. I sold it for 15 lakhs. Let's say 15 lakhs is also the fair value. Okay. And now I'm going to take it back on operating lease. Okay. The remaining useful life was 10 years. I'm going to use it only for 3 years. So I will also recognize a right of use. Right. Okay. Now, to the extent I have retained the use, I have not really recognized the gain, realized the gain. So optically, my asset of 10 lakhs sold for 15, gain seems 5. But they are saying, no, out of that, proportionately, to the extent you still retain the right of use, you should not recognize the gain. So there's a detailed calculation. I will actually recognize the gain, not of 5 lakh, but the gain which relates to the value, which is other than my right of use. So to the extent the gain, to the extent the difference of this 5 lakh relates to the right of use I have retained, I will not let's say for argument's sake, without getting into calculation, out of this 5 lakh, 1 lakh relates to the right I have retained. So I will recognize a gain of only 4 lakhs rather than 5. So let's say I will de-recognize my PPE. I will recognize my ROU. Okay. And I will also recognize my liability, lease liability. And that's it. And only the difference to the extent of gain, it relates to the, let's say, I'm just saying, just for just to kind of get an idea, let's say, I have retained 30% of the asset. In a way, the ROU is 30%. So I will not recognize gain of 30%. I will recognize gain of only 70%. So that's the broad concept. One, we don't expect there to be sale and finance lease back. Secondly, you don't recognize the full gain on sale. You recognize it only to the extent you have not retained the ROU. To the extent of the ROU retained, you don't. And the third bit, a very interesting point is, let's say if there was a transaction which was beyond fair value, let's say instead of 15, I had sold it for 70. They are saying this 2 lakhs is nothing but additional financing that you are getting from the buyer lessor. You account for it under IFRS 19 more like a financing arrangement. So I will split this into two. 2 lakh becomes more like a financing arrangement. And this concept which I said of how much gain, etc. On that 2 lakhs, I will not recognize any gain at all. So though I sold it for 70, 2 lakhs, I will account for it as a financing arrangement. Then I will still apply on that 5 lakhs, the concept which I earlier spoke about. So quite a bit of a change as far as sale and finance leaseback is concerned.
Great. Very quick, Kaleshwar sir, can you tell us if there are any exemptions given to small and medium companies regarding the compliance of AS 19 and Ind AS 116? Also, are non-corporate entities required to follow AS 19?
Yes. Basically, Indian Accounting Standard Rules 2021, which has redefined the definition of small and medium-sized companies.
Right.
So basically, what happens is, if you remember the previous conversation where I was stressing as far as AS 19 is concerned, those 3 elements: preparing a reconciliation statement, providing a details in relation to sublease, and the third is specific disclosure in relation to my lease contract. So if it were to be small and medium-sized companies as defined, then to that extent, these 3 details I don't have to disclose. But I have to be very clear in my disclosure, saying that in accordance with accounting standard rules applicable to small and medium-sized companies, the following details have not been applicable, and accordingly, we have not disclosed. To answer your question, for small and medium-sized companies, accounting standard 19 as well as 1116 is applicable. So accounting standard 19 is applicable because 116 we have a different category of companies which comes into picture. So let us restrict to accounting standard 19. However, as far as disclosure requirement are concerned, they are little lenient, especially these 3 points which I've told. Those disclosures are not required to be made. Coming to the next question, as far as 116 is concerned, 116 is applicable only for specific categories of companies, basically based on the net worth and the listing criteria. So there we don't have any exemption. So you have to mandatorily comply all the disclosures. Now moving on to non-corporate entities, what has happened is the ICAI has basically given us a guidelines classifying these non-corporate entities based on the turnover and borrowing into 4 categories. So large, medium, small, and micro. So large is basically which has a turnover of more than 250 crore and a borrowing above 50 crore. Medium size is basically turnover between 15 to 250 crore and a borrowing between 10 to 50. Small is basically where a borrowing is between 2 to 10 crore. The last one is basically it's an open thing which doesn't, whatever entities do not fit into the other 3 categories will fall into the 4th category. So what it says is for the large entities, accounting standard have to be mandatorily complied with. However, for the category 2, the medium, small, and micro. So for these 3 entities, we together call it as SME enterprises. For the SME entity, accounting standard have to be complied. However, they don't have to go with the disclosures. To put it simple, disclosure requirements have been given a waiver for these entities.
Okay.
Yes.
So now we'll attend to some of the questions that have been posed in by the attendees. So either of the speakers are welcome to answer them. So the first query that I have is, what is the industry practice of treating short-term leases less than 6 months, which gets extended periodically for another 6 months?
So the question is basically, as I told, we have to decide at the inception of a contract whether what is going to be the duration. At the inception of the contract, if you're sure that every 6 months you have an unconditional right, or you're pretty sure that you're going to extend, then you have to go with the single lease accounting if you're a lessee. However, at the inception of a contract, if you're not at all sure, you have entered into a contract and there is no clause for renewal and such thing, and in that case, you can go for a lease accounting, or you can go for an exemption has been provided for a short duration.
Short lease. It's basically reassessment at the time of, during the course of the lease term itself.
But the decision has to be made at the inception of a contract.
Yes, ma'am. Yes,
if I can just add here, like I said, many could be tempted to just get into a short term because, like I said, you would not have to do the full accounting. We need to be very careful, seriously on this. Okay. If we believe that 6 months, while it's an initial period, non-cancelable is 6. And like I said earlier, the shorter the period, the more likely of renewal, depending upon what is the asset. Okay.
Correct.
Let's say if the asset is, let's say if it's a factory premises, to say I will only do 6 months and not really. I think the real test will be able to demonstrate that the lease term in such a case wherein it's 6 plus 6 plus 6, and I do not know whether this is an auto renewal. One could be every 6 months it will get renewed automatically till the time you really say no. The other is to say every 6 months I will have a right to kind of renew. Okay. So it depends on that. And I think if the lease term, you're very sure after looking at all the, the requirements of the standard that this is, yes, a short term, only then. And then of course, you're right. If you actually land up exercising, you'll get into reassessment. I know we're short of time, but 2 points which just come to my mind because of this question, which I wanted to. One very interesting thing when you look at the lease term under India's 116, while, like I said, practically the definition, not practically, when you read the definition, doesn't seem to really make that much of a distinction. But I did speak about enforceable, non-cancelable, wherein a big change, when you really apply it, companies are now applying it very robustly. Earlier, they didn't really think so much about the lease term. So let me put it like this, 3 situations which the standard talks about. It says if both party can cancel, okay, less or lesser without any penalty, then there is no lease contract only, because there's nothing enforceable. If you and I can move out of it at any point of time with no penalty, and penalty, like I said, in a broader context. The second is, let's say the lease is cancelable only at the lessee's option. So let's say I have a 10-year lease, and as a lessee, I have a right to cancel after 3 years at any point of time by giving a 6 months notice. My non-cancelable period will be 3 years and 6 months, 3.5, because मुझे notice period भी देना है. Now, but that's a non-cancelable. What is my lease term? I will look at reasonably certain to exercise. But let's say this is where the termination option was with the lessee. Now let's say the termination option is with the lessor. It's 10 years, the lessor can cancel at any point of time after 3 years, giving 6 months. Now, while AS 19 or India 17 did not really say anything specific to this, by practice, even there, what used to happen, there used to be a judgment made, will it really get exercised, etc., and all those things, and you would determine. I mean, I'm just saying there was quite a bit of some companies, I know this is how they looked at it. Here, the standard says that when you're looking at lease term, lessor's right of cancellation, you ignore. So even though the lessor has a right of cancellation or termination after 3 years, I will actually not take that into account. So are you getting my point? So it's a very fine distinction they're making in terms of who has the right of cancellation and so on. And just one bit which we haven't covered is that lease assessment word. We've not covered lease modification at all. I just want to make a point. When you do a lease reassessment, you remeasure your lease liability for the revised lease term, but you don't change your discount rate. The discount rate would be what you took earlier. Whereas when you do lease modification, depending upon various situations, in some cases you may, in some cases, basically in lease modification, you'll end up even revising your discount rate. So there could be, I'm just saying, in some cases, it would seem that reassessment accounting is, if I was to treat this as a lease modification, probably there would be no change. Even under lease modification, I would do the same discount rate without changing. But all said and done, this is a lease reassessment. Lease modification may require you to use a revised discount rate. At times, the adjustment in a lease modification would be to the ROU. In certain cases, there could be a differential which could be going to the P&L as well. So just wanted to kind of just mention that point.
Right. Okay, so quickly, next question. In an international oil extraction contract, sometimes the lease is under renewal at the balance sheet date. Should we prepare accounts based on assertion of the management that lease is likely to be extended or not? What kind of decision should be taken with respect to this?
Well, I spend so much of time on lease term and lease term reassessment.
Yeah.
So one is you should have factored this into your lease term original. Let's say you thought you would not exercise. And as I mentioned, you don't do your lease term reassessment basis your intention, expectation, market factors. Unless until para 20 or 21, which requires a business decision wherein you are effectively committed. Unless until you don't do that, you will not. So the answer is not, I mean, it is just, you will have to see whether para 20 or 21 is met, and I'm presuming that renewal was not reasonably certain to be exercised when you did your initial lease term assessment.
Great. Next question. In case the lease agreement is modified to the original space for furniture, what would be the payment of lease for these additions when the original lease is already considered as financial lease? So it's an extension to the original lease. It was not part of the original
lease. Actually, frankly, we've not got into modification. Answering this would be, till the time we really don't cover modification in total, this may be a bit misleading unless until Prasad wants to, because a lot of it would depend upon lease modification can be various ways, in terms of adding various terms and conditions.
Maybe
I don't know. I think given the lack of time.
Yeah, I think then. Okay, so we have Abhay sir with us. Welcome to the webinar, sir.
Thank you very much. Thank you, Asta.
And in fact,
yes, good evening, Chairman.
Namaste, Abhay bhai. In fact, it was a great deliberation, and not only on the this web link, even on the YouTube also many persons joined, and they have been very, very appreciative of the total discussions today. And yes, this would be available on the YouTube. It would be available on the ICI link. I congratulate both the panelists and the moderator for doing a fantastic job, and Shalini also. I'll request our Vice Chairman, Abhay Chajirji, the CCM from Bhopal, to give his concluding remarks to wind up.
Thank you so much, Pramodji. Of course, it's all under your guidance that these webinar being initiative and the initiatives which you have taken, I think, and having these webinars more a practical discussion, I think that is what is important for each participants, because when you learn all together it is difficult, but when you learn every topic in a span of time, I think that is where the real learning is. And I think that is a very good initiative which we have taken to have these webinars at least once a month minimum. And none other than excellent speakers, Archana Madam, of course. She's been there, and a lot of discussions we have in ASB also as a member, and other study groups and discussions. But I think I just joined because I had a meeting of ASB only. I was discussing some of the agendas which we have in ASB. And thank you so much, Archana Madam, Prasadji, and excellent deliberation and very vital topic. And of course, where you have covered the accounting treatment, that a few minutes which I joined, the modifications, the treatment for the lessee, how the comparison I'm sure would have been discussed in terms of the AS 19 and the Ind AS 116, which is so relevant. And more particularly, when we look from the small and medium enterprise entities, where how the accounting treatment would be, more particularly with respect to AS 19 and wherever the applicability of Ind AS 116. I'm sure all those would have been covered and discussed. And thank you so much, Asta, also for a wonderful moderation. And once again, a big thank to Archana Madam and Prasad for sparing your valuable time here today on a very important and interesting discussion which we had. and all the participants who are here, and I'm sure would have really gained with the experience of these speakers and how the practical issues which we face during the audit is to be attended, and I'm sure would really be benefited going forward when we do the audit of the financial statements. So thank you so much, and of course the chairman of the ASB, Pramodji, for always giving me an opportunity to be part of any event of ASB and giving me the freedom to speak wherever you have
it is
to
your
speak.
ASB, sir. It is your ASB, sir.
Thank you so much. Thank you so much, and Shalini, of course, in the office for having this webinar today. Thank you. Thank you so much. Thank you.
Thanks, everyone.
Thanks.
Okay, thank you.
Very much. Thank you so much.
Thank you, everyone. Thanks the participants too.